This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
The world's oil supply will exceed demand in 2025 even if OPEC Plus cuts remain in place, the International Energy Agency, IEA, said in its monthly oil market report on Thursday, as rising production outside the producer group is met by sluggish global demand growth. Our current balances suggest that even if the OPEC Plus cuts remain in place, global supply exceeds demand by more than 1 million barrels of oil per day next year, the IEA said. The Paris-based agency left its 2025 oil demand growth forecast little changed on the month, expecting oil demand to rise by 990,000 barrels of oil per day next year.
Oil prices were largely steady on Thursday, with traders holding fire after declines earlier this week on a stronger US dollar and worries about rising supply amid slow demand growth. Brent crude futures were down 3 cents to $72.25 a barrel at 0937 GMT. US West Texas Intermediate crude futures were down 7 cents to $68.36. The primary driver of oil prices, both in the near term and looking ahead, will be the direction of the US dollar, said Philip Nova investment analyst Danish Lim.
Moving on to the top news in the energy sector.
Onshore storage volumes of fuel oil inched higher in Singapore for a second consecutive week following a sharp plunge in end October, data showed on Thursday. The inventories rose 1.8% at 18.35 million barrels, about 2.89 million metric tons, in the week to November 13, based on Enterprise Singapore. The build was driven by higher net imports, which were at about 508,000 tons in the week, more than doubling from the previous week, calculations based on the data showed.
U.S. refiner margins for gasoline and diesel will be relatively unchanged next year, the U.S. Energy Information Administration said on Wednesday, signaling relief for fuel producers who saw profits slump sharply since 2022 on slowing demand growth. Refiners around the world reaped record profits in 2021 and 2022 from the post-pandemic surge in travel demand and recovering economic activity. However, margins then dropped sharply as mammoth new plants opened up around the world and demand growth slowed, partly due to efforts to transition away from fossil fuels. The planned closures of 2 U.S. refineries next year, LyondellBasell Industries' 263,776 barrel per day Houston refinery and Phillips 66's 139,000 BPD Los Angeles refinery, will help stop the slump in margins for plants that remain, the EIA said in its November short-term energy outlook. Next, we have the top news in metal markets. Chinese copper smelters are likely to further cut production, shut down or extend maintenance to cope with a severe shortage of raw material or concentrate supply next year, participants at a conference in Shanghai said on Wednesday. Global mine disruptions and smelters expanding capacity at a fast pace have led to extreme competition for copper concentrate and pushed treatment charges, a gauge of concentrate availability, to historic lows. The concentrate deficit is estimated at more than 1 million metric tons next year, analyst Zuo Haoan from Minmetals Nonferrous Metals Company told delegates at the CRU World Copper Conference Asia.
Iron ore futures prices fell to a 3-week low on Thursday, as supply of the key steelmaking ingredient remained firm amid a weaker steel market outlook, although fresh stimulus measures by top consumer China for its property sector limited the losses. The most traded January iron ore contract on China's Dalian Commodity Exchange ended daytime trade 1.37% lower at 756 yuan, $104.38, a metric ton. The contract earlier in the day hit its weakest level since October 24 at 751 yuan and 50 fen. The benchmark December iron ore on the Singapore Exchange was 1.81% lower at $98.72 a ton, as of 0714 GMT.
We will now look at the top news in the agricultural sector.
European Union wheat exports are increasingly focused on the western side of Africa after losing out to Russia in major North African and Middle Eastern markets, traders said on Wednesday. EU shipments of common wheat, or soft wheat, so far in 2024-25 are 30% below the year earlier level, curbed by Russian-led competition and a rain-hit harvest in top EU grower France. Nigeria is currently the top destination, while previous leading outlet Algeria is only in 5th place, EU data shows. We're moving more west, Karolis Seimas, president of the Lithuanian Grain Processors and Traders Association, said of shipments from the Baltic states.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.